Your retirement fund is betting on the government not going bankrupt. That's the bet. Your entire financial future depends on governments being able to repay their debts. And, spoiler alert, several countries already can't pay their bills. State and local pension funds hold $490 billion in US Treasury bonds. That's 8% of all pension assets. Your retirement money locked into government bonds paying 3 to 5% interest while inflation runs at 6% or higher. You're losing purchasing power every single year, on purpose, so governments can borrow money cheaply. And if the government defaults, your pension disappears, gone, forever. This is the pension fund trap, and you're caught in it whether you know it or not. Let's talk about what $490 billion in Treasury bonds actually means for your retirement. State and local pension funds manage money for millions of teachers, firefighters, police officers, and government workers. People who spent decades in public service, contributing to their pensions every single paycheck, trusting the money would be there when they retired. That money is now being used to fund government debt. $490 billion sitting in Treasury bonds earning 3 to 5% annually. Sounds safe, right? Government bonds are risk-free. That's what they tell you. But here's the reality. Inflation has averaged over 6% in recent years. When your investment earns 3%, but inflation is 6%, you're losing 3% of your purchasing power every year. Your retirement savings are shrinking in real terms. The longer you're invested in these bonds, the poorer you become. And this isn't an accident. This is the trap. Pension funds are forced to buy government bonds, providing cheap funding for government spending. In return, pension beneficiaries get returns that don't keep up with inflation. It's a direct wealth transfer from retirees to governments. So why do pension funds keep buying these bonds if they lose money after inflation? The answer is simple. They have no choice. First, regulations. Many state laws require pension funds to hold a certain percentage of assets in safe investments. Government bonds are classified as the safest investment possible. So by law, pension funds must buy them. Second, liability matching. Pension funds owe fixed payments to retirees. They need stable, predictable returns to match those obligations. Stocks are too volatile. Real estate is too illiquid, so they buy bonds, even when the returns are terrible. Third, political pressure. Pension fund managers are often appointed by politicians. Those same politicians need buyers for government bonds to fund their spending. So pension managers are pressured to buy treasury bonds regardless of whether it's in retirees' best interest. The result? Your retirement is being sacrificed to fund government debt, and everyone involved knows it. Here's where it gets worse. As inflation continues, pension funds lose purchasing power. As they lose purchasing power, they become underfunded. As they become underfunded, they need higher returns. But government bonds pay less than inflation. So what do pension funds do? They take more risk. They invest in hedge funds, private equity, and risky strategies promising higher returns. These strategies charge massive fees and often underperform. Now the pension is losing money on both ends, low returns on government bonds and high fees on alternative investments. CalPERS, the largest public pension in America, is only 70% funded. They need $160 billion more to meet their obligations. Where did that money go? Partly to government bonds earning 3% while inflation ran at 6%, partly to Wall Street fees eating up returns. The Illinois state pension system is barely 40% funded. They owe retirees $144 billion more than they have. They hold billions in treasury bonds, losing purchasing power every year. Meanwhile, the state keeps borrowing and the pension keeps buying bonds to fund that borrowing. It's a death spiral. Governments borrow, pensions buy bonds, inflation eats returns, pensions become more underfunded, governments borrow more. The cycle continues until something breaks. Now here's the terrifying question. What happens if the government can't pay back those bonds? Look at Greece. In 2012, the Greek government defaulted on its debt. Bondholders lost 53% of their investment overnight. Greek pension funds held massive amounts of government bonds. When the government defaulted, pension funds collapsed. Retirees who worked their entire lives saw their pensions cut by 40 to 50%. People who contributed for 30 years suddenly received half of what they were promised. Some received nothing. The government bonds that were supposed to be risk-free became worthless paper. Argentina has defaulted on its debt 9 times. Every time, bondholders get wiped out. Pension funds holding Argentine bonds lose everything. Retirees who trusted the system lose their life savings. And it's not just distant countries. Puerto Rico defaulted in 2016. US territory, part of America. Their government bonds became worthless. Pension funds that held Puerto Rican debt lost billions. Your pension fund holds $490 billion in US government bonds. The US has never defaulted. But the US also has $36 trillion in debt, growing by trillions every year, with interest payments now exceeding $1 trillion annually. How long can that continue? We're not talking about if anymore, we're talking about when. Japan's debt to GDP ratio is over 250%. Their pension funds hold trillions in Japanese government bonds. If Japan defaults or inflates away its debt, Japanese retirees lose everything. Italy's debt to GDP ratio is 140%. Italian pensions hold massive amounts of Italian government bonds. If Italy defaults, millions of retirees are wiped out. The US debt to GDP ratio is 120% and climbing. State and local pensions hold nearly $500 billion in treasury bonds. If the US defaults or inflates away its debt through hyperinflation, those pensions collapse. And the response from governments? Don't worry, we'll never default. The same thing every government says right before they default. There are alternatives. Pension funds could invest in assets that actually beat inflation. Real estate, commodities, stocks, international diversification, anything other than low-yielding government bonds. But governments need buyers for their bonds. They need cheap funding. So they create regulations forcing pensions to buy bonds. They pressure pension managers politically. They classify government bonds as safe even when they lose money after inflation. And when pensions fail, when retirees discover their money is gone, governments blame demographic challenges and actuarial miscalculations. They never admit the real problem. They trapped pension funds in government debt that couldn't keep up with inflation. If you have a state or local government pension, you need to understand. Your retirement is invested in government debt. If that government goes bankrupt, your pension disappears. If you're a teacher in Illinois, your pension holds Illinois state bonds. Illinois is effectively bankrupt. If they default, your pension is gone. If you're a firefighter in California, CalPERS holds hundreds of billions in bonds. If inflation continues eating those returns, CalPERS can't meet its obligations. Your pension gets cut. If you're a police officer in New Jersey, your pension is massively underfunded and heavily invested in bonds losing purchasing power. Your retirement is at risk, and there's nothing you can do about it. You can't move your pension to better investments. You can't opt out. You're trapped. State and local pension funds hold $490 billion in government bonds. That's 8% of all pension assets. Your retirement money, earning 3 to 5% while inflation runs at 6% plus. You're losing purchasing power every year to fund government debt. And if governments default, Greece, Argentina, Puerto Rico, it's already happened. Retirees lost everything. Their safe government bonds became worthless. Your pension fund is making a bet that the government won't go bankrupt, a bet that inflation won't destroy your purchasing power, a bet that the system won't collapse before you retire. But several countries already can't pay their bills. The US pays $1 trillion annually just on interest. Japan owes 250% of GDP. Italy is on the brink. The math doesn't work. Your retirement is trapped in government debt. And when that debt implodes, so does your pension. The question isn't if, it's when, and whether you'll have anything left when it happens. Welcome to the pension fund trap. Population, everyone with a government pension. Exit strategy, none.